Eurozone growth has lost momentum rapidly. Idiosyncratic factors such as the new emission testing regulations and higher oil prices have exacerbated the decline in Q3. But even if we set aside these idiosyncratic factors, there is a genuine loss of momentum in Eurozone expansion. So what's going on? One of the main reasons is deceleration in global growth. Trade wars have dampened external demand. It's weighing on risk. It's weighing on competitiveness. Italian risks refuse to go away. And at the same time, the supply or the infusion of QE liquidity by the developed market central banks is ebbing. We have been highlighting that the ECB's growth projections for the euro area look optimistic, and we expect further downward revisions to these growth forecasts in December. We also think that the ECB will have to adopt a more dovish exit from its QE program than what we had penciled in at the start of this year. So one of the tools that's available to the ECB is TLTROs, which is the targeted long-term refinancing operations. These are essentially schemes under which the ECB lends at subsidized rates. The maturity is up to 4 years. These schemes are popular because it's less politically sensitive than other options on the table. Crucially, if the ECB does not engage in some sort of TLTROs, it would imply significant liquidity squeeze on Italian banks in particular. To put things in perspective, the outstanding amount of TLTROs under the second round of operations is around 722 billion euros. Italy alone accounts for 30% of these loans, which is as high as 15% of Italian GDP. Now, this is not surprising given the really poor state of Italian banking sector and its large funding needs. But what this means is that when the first set of repayments are due in June 2020, the pressure will start mounting on Italian banks. Well, the Basel III regulations mean that the liquidity squeeze will be felt as early as the spring of next year. But TLTROs can at best postpone the oncoming onslaught of liquidity squeeze on Italian banks. They do not address the causes of the problem. They are not solutions to this problem. It's just basically kicking the can further down the road, and that too not for very long. The other problem that the ECB will face is the revision of its capital key, which is likely to worsen the lopsided nature of its QE program. When I say lopsided, I'm referring to the fact that the ECB buys a lot more German bonds than BTPs, although Germany runs a budget surplus and has a much lower public debt, and as compared to Italy, which runs a budget deficit and has one of the largest public debt ratios globally. What will happen in January is that the capital key will be revised, and this would mean that Germany will have a higher capital key weight than say Italy, because Germany has been expanding at a much more rapid pace than Italy over the last 5 years. One of the options that the ECB could use is reinvest the maturing securities on its portfolio into longer dated securities. In a sense, this is the ECB passively managing the duration of its portfolio. It will sort of ease the pain on financing conditions, but not in a meaningful way unless there are decent or meaningful changes to the other restrictions to the other restrictions that the ECB has imposed on its QE program. What would be a much better option is for the ECB to actively manage its portfolio, actively manage the duration of its portfolio. In other words, sell short-dated securities and buy longer-dated securities, essentially engage in a Fed-style operation twist. This option, however, does not seem to be on the table, and the ECB doesn't seem to be in a mood to adopt this. In a nutshell, a slowdown in global growth, tighter financial conditions globally, and continued risks from Italy will weigh on Eurozone expansion. Because doesn't seem to be an appetite for a genuine fiscal policy boost. And in the face of constraints on the ECB policy, especially with regards to its QE policy, the central bank's options seem rather limited at this point in time.